Okay, good afternoon, everyone, and welcome to the Chamber's Economic Overview and Forecast for 2021. I'm Jim Rooney, President and CEO of the Greater Boston Chamber of Commerce, and I'm glad that you're all able to join us today. I was thinking about these events over the past few years and economic outlook and forecasts generally, and the word that popped into my head in terms of what the business community most does not like is uncertainty. And I think that we can put uncertainty in big bold letters as we think about 2021. On my list, and I'm sure our speakers will talk more about this, is what's going to happen with the vaccine and COVID. We have a new president and potentially a divided government. Small businesses hurting and many people are hurting as well. We've got consumer choices and how people will behave as the economy reopens that we're really not quite sure of. We've got political conditions in Europe and in other parts of the country that will affect our economy. So I'm sure our speakers will talk a lot about the uncertainties and what might guide their thinking as we look into 2021. And then there's the other question of, what does economic health and stability look like? And for many people, that's a personal kind of observation. As we think about the broader economy, we know that some people look at the stock market and that's their definition of economic performance. Others, it's employment rates. Others, it's consumer confidence. And our friends over at AIM, I was looking today, actually released a report that, at least from a business perspective, confidence has gone up a little bit for the first time this year. It reached a low in March for 2020, but it's starting to climb up. So confidence is a big issue. And of course, the gaps in society and in our economy are big issues in terms of the way people think of the economy. So there's a lot to talk about. A lot of assumptions go into thinking about this, and I'm sure that we'll hear from our speakers today about how they're seeing things. A couple of housekeeping issues. This program is being recorded and will be shared on the Chamber's YouTube page shortly after the event. I would encourage you to use the chat and Q&A functions during today's conversation if something of a question comes to mind. And with that, I have the pleasure of introducing today's speakers. First, I'd like to introduce Megan Greene, global economist and senior fellow for the Harvard Kennedy School, where she's now teaching and writing a book on how the new economy is driving wealth and income inequality. Megan was previously global economist at John Hancock Manulife Asset Management and the founder and chief economist at Maverick Intelligence. Megan will be kicking off today's program with her outlook for 2021 and the economy that we'll be experiencing from both a global and a U.S. Perspective. And after Megan's presentation, she'll be joined by two more leaders to have a follow-up discussion and conversation of what this all means to us in the greater Boston business community and our local economy. Joining Megan at that point in the conversation, I'm happy to welcome Carol Bulman, CEO and president at Jack Conway Realty. Carol has more than 30 years of experience in the Massachusetts housing and mortgage industries and plays a leadership role at the local, state, and national development. And I was glad that Carol was able to join us today because as we think about the economy, certainly issues like housing prices, development, construction, the inventory of housing, regulations affecting housing, interest and mortgage rates, are all factors in the larger economy. And I guess one of my questions, just setting this up for Carol, is housing a leading or a trailing indicator as we think about the economy? Carol has had commitment and dedication to not only contributing to her industry, but to giving back to communities, and has received numerous awards, including the Boston Business Journal's 40 Under 40 Award. Carol, we're glad to have you with us. And moderating the conversation when we get to it will be Janet Wu, reporter and anchor at Bloomberg and an adjunct professor at Emerson College. Janet speaks to leaders in all of the industries that drive Greater Boston's economy on a regular basis. So what she's hearing from those leaders, I'm sure will be informative in the discussions. Janet's work can be found in the Boston Globe and the New York Times. Janet's a founding member of She Gives, a philanthropic organization of women, and she's been named New England Girl Scouts Leading Women of the Year. Janet, thank you for participating with us today. I know that there's a lot going on in the news cycle by both our president and our governor, so that you're keeping your eye on during the conversations. But to get things started, I'm going to turn it over to Megan for her presentation, and then we'll get to the conversation.
Great. Thank you so much for that. And thanks so much for inviting me to speak to this audience. I'm going to give an outlook for the US economy and also a little bit on the Massachusetts economy and how it all fits into the greater global picture in 2021. To figure out where we're going in 2021, though, it's worth just quickly revisiting where we've been this year. It's hard to remember back to January before this virus hit, but we economists were all trying to read the tea leaves very carefully back in January to figure out when the longest recovery we've ever had might end. And most economists thought it would end actually pretty soon. We just thought it was going to be really subtle. We had no idea it would all come and hit us in the face pretty much. But most of us were pointing towards corporate debt as the potential trigger. There were a few others, but debt was a really big theme, which will come back later in this conversation for sure. Now, I think Massachusetts has broadly followed most of the national trends. In terms of employment, the Massachusetts unemployment rate, it peaked a bit higher than the US. It was at 17.7% in April versus 14.7% for the US on average. The labor force participation rate is a little bit higher in Massachusetts than the national average. Interestingly, though, spending in Massachusetts is up much more than the national average. So spending since the beginning of the year is up 12% across Massachusetts versus it being down a little bit by 2.5% for the national average. And I get those numbers from my colleagues at Harvard, Raj Chetty and others who run the Opportunity Insights website, which looks at credit card and debit card data and can parse it out by zip code. So we can figure out what's going on in Massachusetts. So spending's more robust in Massachusetts at the moment than it was, than it is relative to the national average. I like to think of this crisis as having happened for the economy in three separate stages. The first stage was when we all locked down and decided to put the economy on a deep freeze. We had a precipitous decline in economic activity. The second stage, or second act really, is when we started to reopen over the summer and we saw this fantastic bounce back in activity. The third stage is the one we've just entered, and I call that the long, hard slog. It's where we've kind of picked all the low-hanging fruit. We've returned a bunch of people who were furloughed back into their jobs. It was always going to be much easier to get the first 20% of people back in their jobs than the last 20%, though. And now we're just kind of in the hard slog. And again, as has always been the case since this virus hit, it will all be determined by the virus. But assuming no massive new spikes, and we are undergoing one spike, but assuming no massive spike where we had the kind of draconian shutdown that we had in March, April of this year, I think that long, hard slog should persist for the US. Now, going into next year, it's worth pointing out that we are still deep in recession in some ways. Yes, we had this bounce back, but we're still way below where we were at the beginning of the year, both in terms of the labor market and also in terms of activity. And so the first priority is going to be to contain the virus. That will be the administration's #1 job. Looking beyond that, I think the administration is also looking to fill in the hole that we dug when we iced the entire economy. And that includes immediate fiscal stimulus, which is being debated right now in Congress. The second priority will be to build back better. So to look at kind of medium-term issues And then the third priority will be to look outside the US and try to reestablish the multilateral system that the US established after World War II and has led ever since. So that's going to be the broad set of priorities for the new administration. Just to give some details on that, in terms of the first one, containing the virus, but also filling in the hole that we dug. I really do think of it as filling in the hole and not as fiscal stimulus. So it's more catastrophe mitigation than it is actually trying to jumpstart the economy. We had the CARES Act at the beginning of this year. It's hard to overstate how quickly that was put together and how big it was, and also how effective it was. But many of the support mechanisms in the CARES Act for small businesses and unemployed people expired this summer and haven't been re-upped. And those that didn't expire this summer are due to expire at the end of this year. And so if we can't get together another stimulus package, the economy is going to hit an air pocket at the end of this year and the beginning of next year until we can get another stimulus package or another mechanism to fill the hole in place. So I think that that's really important. I do think that we will get a package, but it is questionable whether it will happen before the new administration is in place. As I mentioned, talks are ongoing, but if not before a Biden administration is sworn in, then shortly thereafter. The size will probably be smaller than $1 trillion. I actually think it should be bigger to give support not just to small businesses and unemployed workers, but also to state and local governments. There will be some element of all those things in a stimulus package. I think it's just a question of magnitude. And I think $1 to $1.5 trillion is probably better than under $1 trillion, if not just because we're trying to perfectly, or Congress is trying to perfectly figure out exactly how much money is needed. Whereas the risk of doing too little is much bigger than the risk of doing too much at this point. So I think we will get a fiscal stimulus. Once that happens, we will turn, or the government will turn its focus to longer term issues. And one of them, I think, if you look at President-elect Biden's campaign pledge, he had a massive spending program. The biggest envelope was for healthcare. Unfortunately, I think with the Republicans likely hanging on to the Senate, and even if they don't, only a very slim majority, the slimmest of majorities for the Democrats, it's going to be really hard to do anything massive on healthcare. The second biggest envelope in the spending plans, however, was infrastructure and climate. And there, I think we could see much more done. I do think we could get a significant infrastructure spending program that's focused on retooling the economy for sustainability. And that deals not only with jumpstarting the economy, insofar as we can get shovel-ready projects underway, and that is always a challenge with infrastructure spending plans. But it also deals with a medium-term issue that, as you mentioned, I'm writing a book on, which is inequality. And if you look at Biden's economic team, inequality and labor market, labor economics is definitely a priority for this administration. And an infrastructure spending program addresses inequality because infrastructure spending is really worker intensive, and it creates really high wage, high hour jobs. So the specific kinds of jobs that we really want to create in the US. So it will not only kickstart a recovery, but it will also upgrade our workforce, which is really badly needed. So I think that will be a central piece of the Build Back Better program. We're looking at tax reforms as well. I think that's going to be really difficult given the slim majority at best in the Senate. More likely, I think, again, the Republicans will probably take the Senate. And so it's going to be difficult to do much on tax. But I do think an infrastructure spending program will be central to the Build Back Better platform. And then I think that the Biden administration will look outwards and we'll try to figure out how to re-engage with our traditional allies after 4 years of kind of turning our backs on allies. There, I think that it's worth pointing out that actually there's a risk, and it's a risk that really shocks and disappoints international audience who I speak to, and that's to say that the Make America Great Again platform that Trump has pushed and Biden's Buy American platform really aren't that different in terms of ultimate goal. So both of them have industrial policy at the very heart of them. It will involve incentivizing companies to come back home, incentivizing companies to create jobs in the US, providing subsidies for things like research and development. And so while the Biden administration will have much cuddlier language around it, I think and the means will be different for sure. I think the fundamental goal won't be that different in terms of how, in terms of what they're trying to achieve. So there will be a much more multilateral approach, but ultimately industrial policy is here to stay, I think. Now, it's worth pointing out that when we hopefully have a vaccine next year, and it is broadly distributed, so somewhere around the middle of next year, we hope, there will be a lot of pent-up demand that's released. And so you will see this long, hard slog turn into another great jump in economic activity. That is absolutely to be expected. And you see that in the personal savings data right now. So we provided all this fiscal stimulus, and you've seen that actually spending for the lower classes who have the highest marginal propensity to spend, so they end up spending most of what they get, it's actually been maintained through this crisis. Now, there are, of course, exceptions to that rule, but in aggregate across the US, spending for low-income people has been maintained. It's spending for high-income people that's actually been cut, and that's because it's been discretionary spending. So as uncertainty has risen, wealthier people have cut back on their spending, but that doesn't mean they can't spend. That just means they're not right now. And so I think that when we do have a vaccine, there's less uncertainty around. Discretionary spending will come roaring back. And so we should get an immediate boost in pent-up demand. Whether that continues or not depends on why you think activity has fallen a lot. Some people say we're just not spending as much broadly because there aren't that many opportunities to spend. So there aren't any opportunities because restaurants are shut down and gyms have been shut down and I can't get on a flight and go on holiday. If you believe that, then you think that this pent-up demand should be released and that should be sustained. I tend to think that actually there's a bit of that, but for the most part, people have been fundamentally shocked by this crisis, and there will be scarring on the other end of this, as there was after the global financial crisis. In which case, I'll go to restaurants 10% less often because I order out all the time now and I've gotten used to that. I'll go to cinemas 10% less often because I have a Netflix account now. If you scale that up across different industries and across the entire economy, that's actually quite a fundamental drag on growth further down the line. So I think that we can expect that it'll take us a while to get back to where we were in terms of the size of the economy before the virus. So we should have this pent-up demand release, but then I think scarring will kind of keep a lid on that as time goes on in the second half of next year. I just want to bring up a couple of risks for next year in terms of the growth outlook, specifically for the US and some of them more globally as well. First of all, the first risk is that we don't fill in this hole. So we don't provide support to small businesses, workers, state and local governments. I think a huge piece of why the economy, if you look at our data for the US, has actually held up much better than most people expected is forbearance. And actually mortgage and rent moratoria, so eviction moratoria. Once that forbearance doesn't happen anymore, I think a lot of businesses and individuals would be in real big trouble, but we've kind of papered over that. And so if we don't provide more support to people and small businesses, I think that's a real short-term risk. I also think there's another risk in terms of credit and debt. So I mentioned at the very beginning that in January, as we were all trying to figure out how this recovery might end, a lot of people were looking at corporate America and thinking, God, there's a debt bubble there that's got to burst somehow. Since then, the Fed has stepped in to support the economy with a wall of liquidity. A lot of it has been earmarked for corporates, even if the Fed hasn't actually bought up much corporate debt. It has said it would, which has made all the difference. And corporates in the US have gone on an absolute debt issuing bonanza. So corporate debt levels right now are way higher than they were back in January when we economists were looking at them thinking, uh-oh, this is frothy, this is a bubble. So is it a bubble now? I think that depends on what you think will happen to rates and to profits. So as long as rates stay really low, as they are, and as they should be for the foreseeable, then debt will be easy to service. It'll be cheap to service. As long as profits remain high, then I think that corporates can handle this debt burden. I believe that the rate side of that picture won't change anytime soon. It's the profit side of that picture that I'm more worried about, because if corporates lose profitability, then it might be harder for them to service the debt, even though debt servicing is so incredibly cheap right now. So that's something worth looking at. If you look at corporate debt to GDP, it's off the charts, never been so high. If you look at corporate debt to market capitalization, though, of the S&P 500, actually it's pretty low. It's about half what it was in 2008 before the global financial crisis. And so based on that argument, actually, a lot of these corporates could issue equity and could go ahead and use that to pay down their debt. And also, a lot of these companies have just issued tons of debt to sit on because there's so much uncertainty. And as soon as we get a vaccine and it's broadly distributed, they'll go ahead and pay that back because they don't need to hoard it anymore. So I think that's a risk. It's not one that I think will be an issue immediately, not in 2021, but further down the line, I think it's something to worry about. And of course, I've said in my assumption that I think rates will stay really low for a long time. I think that's obviously my view. That's many people's view, but there are two things that could change that. One is if inflation were to accelerate significantly. And there are some who are saying, look at all the money we have thrown at our economy to support it in the face of this virus. That if you learned economics 50 years ago, you would learn that if you provide that much stimulus to an economy, it should feed through into inflation. Now, a lot has happened in the past 50 years. There are a lot of reasons why it's really difficult to generate inflation these days. The Fed hasn't managed to hit its inflation targets for roughly 12 years, not in a sustainable way at least. So I actually don't think we'll see a huge acceleration in inflation. We will see one in April of next year, though, and for a couple of months, because the year-on-year comparison will take into account inflation being incredibly low when we shut down our economy this year. So it's just a statistical quirk, but that will get people who are worried about inflation saying, ha, see, I told you so. I would say look right through that. So I don't think inflation is going to accelerate significantly in a sustained way, but if it were to, then central banks and the Fed might feel like they had to hike rates and borrowing costs would rise, and then that debt burden would get a lot harder to afford. The other thing that could boost rates is if we had a huge jump in productivity. And we actually have had a huge jump in productivity over the course of this year as low-hour, low-skill, low-wage workers have dropped out of the workforce. That's boosted the overall productivity of the economy. That's not a good reason to have productivity. That's a bad reason to have productivity growth. And I don't think that will continue as we're seeing temporary workers who were laid off have gone back into their jobs increasingly. And so I think we won't see that fundamental play out over next year. But if we did for some reason get a boost to productivity growth, that could happen because technological innovation is finally widely adopted and implemented and finally feeds through into the productivity data. That could boost inflation and cause rates to hike, cause central banks to hike rates. And so I think that's a risk that we need to look at. And then a final risk is a bit more global. Actually, before I move on, I should say I'm worried about the corporate debt burden. I'm not worried about the sovereign debt issue. So a lot of people are worried about how we're ever going to pay for this fiscal stimulus that we're providing in the US and in other countries. For the US in particular, we have more space because we have the global reserve currency and the deepest, most liquid market in the world, the treasury market. So we do have this exorbitant privilege, but even so, I think how we look at debt is fundamentally wrong. So particularly sovereign debt. So we look at debt to GDP usually to see if a country's debt is sustainable. Debt is a stock and it's backwards looking. GDP is a flow. Anybody who's ever taken accounting or economics knows you should never compare stocks to flows. So I don't know why we do this in economics, why we make this exception for debt to GDP, but it's the wrong thing to be thinking about. I think we need to think instead about debt servicing relative to GDP, and debt servicing is incredibly cheap right now because rates are so low. In fact, they're negative for the US and most developed countries. So actually our government's getting paid to issue debt at the moment. And so in some ways we can't afford not to be issuing debt to provide this fiscal stimulus. Ironically or counterintuitively, we have more fiscal space now than we did in 2009 when borrowing costs were higher, even though we have a higher debt burden right now. We have higher debt to GDP, but it's so cheap now relative to 2009. that we have a lot of space. So I'm not worried at all about our sovereign debt burden, just the corporate debt burden. I think our government should go ahead and spend what they need to spend in order to fight this war and worry about how they're going to pay for it much later. The final risk I would highlight is sort of who's going to drive global growth next year? Who will be the engine? And this is a global question. Back after the global financial crisis, the clear answer was China. China pulled all of the levers it had to stimulate growth domestically, and it ended up growing around 10%. And that pretty much pulled the rest of us out of the global financial crisis. So China did us all a massive favor in 2008, 2009. This time around, that's not going to happen. China's the only G20 country that's actually expected to grow this year, so it's certainly doing better from a growth perspective than the rest of the major economies, at least. But it will grow by around 4 to 5%. That's very different from 10% back in 2008, 2009. So we can't rely on China. We probably can't rely on other emerging markets either, given that they are fiscally constrained in many cases. And so it will be more difficult for them to provide stimulus measures, even as emerging market central banks are being more aggressive this time around than they were last time after the global financial crisis. So it probably won't be China, probably not other emerging markets. Could it be Europe? Maybe. Europe has put together this recovery fund that does actually provide some solidarity, unlike after the global financial crisis when we had the Euro crisis and it was every country for itself pretty much, and you got a bailout if you needed it, but with incredibly punitive conditions. So there is a recovery fund. It hasn't been fully passed yet, to be fair, but I expect it will be. And it offers both grants and loans to countries that have been hit by this crisis. A lot of European countries have said they are not interested in the loans piece, though, because they know that it will come with some conditions. They'll have to pay it back. It will go on their debt burden. They just like the grants, which kind of cuts the full envelope in half for the recovery fund. And so it will certainly help. But as we're seeing, Europe is largely locked down right now, in some form of lockdown, and that will probably continue over the course of the winters. So Europe will be starting the beginning of the year on pretty weak footing. It'll be hard to recover significantly from there. So I don't think the growth engine will be Europe. And that kind of leaves the US. So we, I think, will have to be the growth engine this time around in 2021. And where's that going to come from? Yes, there might be some government spending. Certainly, as I mentioned, I expect an infrastructure program to be implemented. Will that be enough? Probably not. I think the real growth engine this time around is going to come from us, from US consumers who have discretionary spending that they can deploy, and probably will as a vaccine is broadly circulated. And so, the US consumer can be incredibly powerful, but will we be as powerful as China growing by 10% after 2008, 2009? Probably not. And so I think we can probably expect global growth this time around to be much weaker than it was when we did have a real leader for global growth coming out of the global financial crisis. So we'll have pent-up demand that's released, but then I think it's going to be a harder slog than most people really expect. I'll leave my comments there and pass it on to Janet for our conversation.
Hello, bravo. I learned so much from that talk. Thank you so much. And in fact, I want to begin by asking you, Megan, a question about your process, because we just saw state lawmakers vote on a state budget that was delayed by half a year, because how do you form a budget when you only have revenue uncertainty? So how do you form economic outlook when there's really nothing certain at all about the economy?
Yeah, it's really difficult. And this time around, as I said at the beginning, everything will be driven by the virus. And so trying to figure out the arc of the virus, how we'll manage to contain it over the next couple of months, let alone the next year, is incredibly difficult. So I think what you have to do is take your best guess and signpost for everyone where you might be wrong. That's the best you can do. And in creating a budget, I think it's important to also look at where the risks lie. And I think in providing a budget at the state level or at the national level, the risks of doing too little are much greater than the risks of doing too much. And so overshooting is the less risky strategy.
one more question for you, Megan, to begin with, before I turn it over to Carol as well. You were talking about the long, hard slog. Do you think that possibly in Boston, the slog will be shorter and perhaps less hard because of our unique economy that is heavily involved with technologies and vaccines to face the pandemic?
Yeah, I do think that's possible. I think Boston has a much more diversified economy than much of America, and so that should help. And I also think it could help that the consumer in Boston is already stronger than the national average. So consumption is up pretty significantly since the beginning of the year in Massachusetts already. And Massachusetts, it's not like we're in a warm, balmy, sunny area where everyone can do everything outside. It's up significantly, even though it's cold and we've had snow twice already outside my apartment, at least. And so I do think that speaks to the strength of the Massachusetts consumer as well.
I'm going to give Carol a moment to come online with us, to unmute herself and join the video. But I want to alert our audience that in case you didn't know, as we were coming online, the governor was announcing a rollback for the entire state to phase 3, step 1 of the reopening plan, which means a lot of businesses will either have to close or have to scale back. So we're going to talk about the impact of that in a moment. But first, I want to ask Carol a couple of questions about real estate, because we are obsessed with real estate here in Massachusetts. We saw just unbelievable demand, both for residential real estate and corporate real estate before the pandemic. Now, of course, drastic changes. Carol, would you describe currently the residential real estate market as still a seller's market?
Janet, thank you. I also want to thank Megan. That was a great presentation, and dovetails so beautifully into a discussion of real estate. Yes, most certainly, it is still a seller's market. Janet, we came into the pandemic, the first quarter, Q1 of this year, we were already rocketing, rolling, prices were high, there was a lot of activity, units up, people are feeling good, consumer confidence strong. So we were already coming into a situation where inventory was low, meaning our listing count was low. So when the pandemic hit, what that did is exacerbated an already situation that was so strained. So absolutely, we've got a strong seller's market, Janet.
Carol, I want to ask you another question. We saw, of course, because of the pandemic, a shift in what buyers wanted. There was, of course, that flight to the burbs. There was a flight to second homes, even with the promise of a vaccine coming by mid next year for most people. Do you expect that trend to continue?
First of all, we were very fortunate in the real estate side. So this is, the word unprecedented has been used so often the last 10 months. But one of the things that was a big surprise to all of us in the real estate business, that 10 months ago, would I ever have thought I'd be sitting here with all of you telling you that we've just been, it's been a flurry of business. And, I come back to what Jim said during the introduction. He talked about consumer choices and behavior. Never underestimate the power of someone who does have a full pocketbook, the power of consumer behavior and those choices that result. So we've seen a lot of different things on the supply side and on the demand side. So supply is down, demand is up. So that's pointing to that perfect storm of prices rising and sadly affordability going down, even though the rates are down, and as Megan said, should continue to stay down. But what we're seeing is a lot of different preferences. Yes, we've all read and we've heard about the flight from the city, from the urban environments to the suburbs. There is a real pull to land, walking paths, air, getting away from elevators and shared spaces. So yes, there has been a change there. But it's really more than that. It's so much about, it's kind of a impassioned change that people are going through, in that people are making different life changes. You often think about a person buying a home down on Cape Cod or down in North Carolina or Florida as a second home. But today, it might not be a second home. It could be an additional home. So there's a lot of people looking at dual housing. So a place to live, but also to work remotely. We're all realizing that we can work remotely, maybe not all the time, but some of the time. Remote schooling. And so there's a lot of behavior changes. Maybe a person wants to bring mom and dad home from the assisted living and live with them. The other behavior change is we always think of, for the last couple of decades, that open floor plan. Everybody wants the great room and the kitchen and everybody in together. Well, we're now all working remotely and we're schooling. So people are looking for division.
Yeah, everyone wants their own office space now, for sure. They want some privacy. Very quickly, Carol, just a short answer from you. Are you at all worried about another real estate bubble?
No, I'm not at this point, because I think consumer behavior is really pushing this. And as quickly as behavior changed to the first part of this, I think behaviors will continue to change as the pandemic changes our life.
All right. So Megan, I want to ask you that you said your biggest fear was corporate debt right now and the ratio of corporate debt to profits and to business. And a lot of people felt that the Fed cuts that happened before the advent of the pandemic were dangerous and left the Fed with really nowhere to go but zero. What's the worst case scenario given the rates are so low, and what's your outlook for them? You said they were going to stay low for a while, but what is the danger of having rates that are so long for a prolonged period of time?
So the danger is on the financial stability side. If you have rates so low for so long, then you end up you sow the seeds for the next bubble and the next crisis potentially. And so we've seen it time and time again. And the question is just what bubble is forming here? And I think corporate debt was already a concern before the Fed's steps in March and April to support the economy and to support corporates in particular. Now it's an even bigger bubble. But that being said, it'll last a while, I think. We just know that at some point, rates will end up going up. At some point, central banks will have to pull back some of this liquidity. And when that happens, it's like the tide going out, and we need to figure out who's swimming naked.
Of course, those low rates affect the mortgage rates. And Carol, I want to ask you about the impact you saw over this last year because of these historically low rates. And also, low rates don't matter if you don't have a house to buy. You can qualify for a mortgage, but if you don't have a house to buy, you still don't have a house.
That's right. And there has been a real pressure. One of the things we talk about is affordable housing, but also workplace living. And first-time home buyers, your older millennials, people starting a family, and that's a big driver for buyers right now. Most often are not buying in cash with large down payments. They don't have a house to sell where they're getting some equity out. So in some cases, they're put in a disadvantage because there's a lot of cash out there. There's investors out there. So that's of course a concern from a real estate perspective. You do want to see your first-time home buyers being able to have an opportunity to buy. It's not unusual for us to see 20, 30, 40 offers on a certain piece of property. So we're seeing now in this month, in December, that things have sort of started to settle down. I'm not unhappy about that. A little bit of catching our breath.
All right. I'd like to, by the way, invite the audience to use the chat feature if you would like to send us a question for our guests today, and I would be happy to weave them in. Megan, you are currently writing a book about wealth and income inequality and how the economy is a driver of that. And this is something that we saw that disparity worsen during the pandemic. What can be done to lessen that disparity?
So it's a great question, and it's something that I think the new administration is looking at pretty closely, if not from their campaign platform policies, also based on the personnel they've chosen, the economics personnel that they've chosen. I mean, they've mainly chosen labor economists so far. So they're trying to figure out what to do to boost the worker. I mentioned one thing in terms of an infrastructure program being a great way to upgrade our labor force. We've had a lot of jobs that have been created over the past 15 years, but the vast majority have been low wage, low hour jobs, and largely in the services industry. And that makes sense because we largely consume services now. And services jobs tend to be low hour, low wage jobs. So one way is to try to upgrade those jobs that we already have and also create new jobs that are high wage, high hour jobs. Infrastructure spending is a great way to do that, particularly if you use it to kind of retrofit all of our buildings for climate change, for example. There's a lot of work to be done there. And as I said, money is really cheap right now. So the government could borrow really low rates in order to do that. So that's one way. Also boosting worker power. So what we saw is it was exactly those hourly service workers who had barely gotten back on their feet after the last crisis who were laid off first in this crisis, were knocked back off their feet. And so I think it showed a lot of us that we really need to do something about this. And one way is to improve wage negotiating power. So boost worker power by encouraging unionization, by penalizing companies for misclassifying workers as contractors instead of bringing them on full time as they should be, and so that they get benefits and some kind of stability. So things like that to boost worker power. And then what we've also seen is that market concentration has increased quite a lot, especially in tech and healthcare, where you get a few superstar firms that rise to the top and they buy up any potential competitors. And if you're a worker in one of those industries and you want to change firms, you don't have many options because there are only a few superstar firms. And so if you get a job offer, you can't really say, well, maybe, but I want you to pay me more, because the firm can just say, like, no, thanks, you've got no other options. So trying to work on antitrust, beefing it up so that we can reduce market concentration, that could help a lot as well.
So we have a lot of questions coming in. Unfortunately, I can't see all of them because they're disappearing, but I have memorized some. Megan, a question for you. We spoke about federal debt. Of course, the federal government can print money. Our state budget was delayed because the states must balance their budgets. You also talked about corporate debt. We have a question from our audience about the idea of small individual businesses taking on debt as a way to survive the economic crisis.
So in some ways, it's the only way small businesses can survive. To some degree, the PPP program was a way around that, so that if you use these loans for the payroll or for rent or mortgages, then they turned into grants, so it didn't go into it didn't count as debt. It didn't go onto your debt burden. But other than that, taking on debt is the only option. And so small businesses might be doing that as a way to weather this, as a way to kind of build a bridge to the other side. The question is, when do we get to the other side? It's now in view, I think, with the announcements that we've had about a vaccine and hopefully imminent distribution of it. But it will take a while for everyone to get this vaccine and to go back to acting as normal. So if those small businesses can make it to the other end, then they should see revenues come in so they can begin to pay down that debt. And again, borrowing costs are pretty low. But it's all a question of timing. If they're looking for a bridge for the next month or two, this is going to be a really long, dark couple of months. And so that plan might backfire.
Wow, we hear that term long, dark winter applied to so many things lately. We have an interesting question again for you, Megan. What will be the biggest indicator of a rebounding economy? Could it be a reduction in overall debt?
I think it could be, but given that the US economy is 70% consumption, I think probably the biggest, fastest indicator what we'd have is in the labor market. It's also because we collect labor market data pretty quickly, and it doesn't get revised that much, and so it's one we can look at. It's not forward looking, but it's not as backward looking as lots of other indicators. And so we've seen the US labor market has been recovering. We have been repairing it, but at an ever slower rate, unfortunately, since the depths in April. And so I think if we were to see the improvement in labor market, so the improvement in new jobs added, an improvement in jobless claims that are, filed for every week, if we saw that accelerate that improvement, then that would be good indication that we're actually on the mend.
Perhaps another indication, given you're pointing out that we are consumer economy, is perhaps a reduction in the personal savings rate, which really jumped during the crisis because people were just nervous and wanted to just bank their money. Carol, I want to ask you, and audience members as well, is to compare this real estate market to past crises, because the big ones that we all remember, the mortgage crisis, the 2008 recession, 9/11, of course, they all greatly impacted the real estate market. So we have a question for you to compare the current rate of foreclosures and evictions to those previous crises.
I think one of the biggest differences is if we look at the Great Recession, first of all, the length of time was extensive. And that had an enormous effect on the overall economy and obviously the housing industry as a whole. But there's a few underlining foundation pieces that are different this time when we went into the pandemic than we went into the last Great Recession. One of them, and I think the biggest piece, is underwriting standards for lenders. I mean, we went into this crisis with a solid underpinning of good bank regulations and underwriting standards for people getting a mortgage. We were in a much different place when we went into the Great Recession, which led to excessive foreclosures, people being obviously underwater in their properties, where today, going into this crisis, people have a lot more equity in their homes. For the most part, people that have mortgages can afford those mortgages and they're holding on to them. Also, the fact that I mentioned earlier about the high inventory, the many listings or the low inventory, at the time there was high inventory, and that actually caused an issue in the overall housing market because there was that excess inventory and supply. So I think we went into this with a lot stronger. Also, unemployment was better, going in, and as a result, consumer confidence. So going into this crisis, which we hope is going to be a lot shorter, and that word slog, I mean, that is exactly how it feels. There's such emotion really with that word, and that's what we're feeling. But yeah, I see there's a big difference. I think there's better foundation.
Yeah, pointing out we do see excess in the upper markets, the very expensive properties, especially in New York. Some of that is being replicated here, but it is a different sort of supply and demand from the last real estate crisis. I want to be able to include this question as well, because I think it's an important one, especially for this audience. Someone is asking you, Megan, about the idea of an equitable recovery. What are some things that individuals and the businesses and the business owners who are watching now, what can they do to contribute to a more equitable recovery?
Yeah, thanks. That is an important question because I've talked about what the government can do, but what can businesses do in order to contribute? I think the Business Roundtable changed their mission away from the point of a corporation being to, maximize profits for shareholders, to the point being to maximize profits for all stakeholders. And I think this was, a symbolic change for now, but the beginning, hopefully, of a much greater change where businesses do actually think about all of their stakeholders, including workers and also clients, and think about how to support them as a way of boosting their bottom line as well. So, worrying about your bottom line and actually supporting all your stakeholders, those aren't necessarily contradictory at all. So I think, what does that mean? Well, I think businesses need to think about who they're hiring. So recognizing that this crisis has hit ethnic minorities much harder than it's hit white people, for example, that it's hit hourly service workers who, were on contract jobs much harder, and trying to think about how to support those groups that were hit the hardest. I think discouraging contractors and encouraging businesses to take people on full time, even small businesses. That would be helpful, particularly in terms of the benefits that you can offer. And then thinking about your customers and how you can support them. So there's one example, AB InBev, a beer making company, which you wouldn't think would be particularly mindful of the well-being of all of its stakeholders, given it focuses on beer. But actually, they've discovered that if they can support the farmers and give them training, for example, so that they can be more effective in producing material inputs for their product, that boosts their bottom line. If they can provide payment systems to the small bars or corner shops that are selling their product, that can be useful. If they can provide support to some of the customers as well, that can also boost their bottom line. So I think for businesses, the important thing is to recognize that actually supporting all your stakeholders is good business.
We have a question that reminds me that even though this is the Boston Chamber of Commerce, so many of our companies are global. I speak to CEOs and they're always referencing, their offices in 80 countries or, 100 different cities around the world. So the question is, how has this pandemic affected the growth of emerging economies? I do recall you saying, Megan, that China was expected to be the only country among the G20. Am I correct that you said was going to have an economy that grows this year? What about the emerging markets?
Yeah, so it's hard to talk about the emerging markets as one group because they're so different between them. But I think there are a number of frontier economies, so the poor emerging markets who haven't had any fiscal space to respond to this health crisis, but have gone ahead and had to do so anyhow. They've been given forbearance from the G20, which just means that they haven't had to pay their debt servicing costs this year pretty much. That's going to have to be extended. And the private sector creditors haven't joined in on that. So what we've seen is a response by the IMF in particular, which is supposed to be the lender of last resort in these kinds of crises. But it's been pretty weak and it's not big enough. And I think we're going to have a series of sovereign debt crises coming down the pike for the poorest emerging markets in years to come. It's probably not a story for next year, but beyond next year, I think it could be. For the larger, sort of better off emerging markets, what we've seen is that they too have issued debt like mad because it was cheap. And so it was an absolutely rational choice for them. And again, that's fine as long as rates remain low. And we have seen emerging market central banks keep rates really low in many cases, not all. But as soon as the liquidity tide starts to pull back, both from emerging market central banks and from the Federal Reserve, which is kind of the world's central bank, then some of those countries could get into trouble.
Megan, I just have to squeeze in one final question. We're down to our last minute, and that is the disconnect between the labor market and the stock market.
Yeah, so the stock market has just hits new records all the time. And that doesn't make sense if you think of how hard things are. But actually, if you disaggregate the stock market, it's the tech companies and the healthcare companies that have led that rally. And it makes sense in this crisis that those companies would do well. So I think it's actually fairly rational. Also, I think what's behind it is the notion that you just can't fight the Fed. And so the Fed is going to backstop the markets. And I think that's right for the foreseeable future.
All right. Well, we are at 2:55 right now, and it's time for me to turn it back over to Jim Rooney for closing remarks.
Well, thank you, Janet. And I am actually going to take the liberty of asking each of you one question, but I do want to start with Carol on the question of housing inventory. What are you seeing in terms of overall inventory, new construction, new development activity that's going on now and likely to occur as we come out of this?
Jim, one of our biggest needs is just that. And we've got some constrictions here in Massachusetts. First of all, we don't have a lot of open land that circles the city where most of our jobs are. But on the other hand, the pandemic and at-home work has provided the opportunity for people to move a little bit further out. And so we're seeing more construction down the 495, down the southeast corridor. So you're seeing where there's land, there's more construction. I think still what is constraining some of the construction is town regulation. Each town has their own set of regulation, making it very difficult sometimes for builders to build in scale. We're also being affected by the cost of labor and the cost of lumber, and there's some supply demand issues there too. So building is not an easy thing right now.
Oh, Carol froze on me. So I'm going to ask thank you, Cal. I'm going to ask the final question to each of you, and it's kind of a fill in the blank question to advise our audience. What are the indicators, or what are you watching for in 2021? What's the one or two kind of indicators or signs that either things are going in a good direction or a sort of negative direction? What should we look for? So fill in the blank. Why don't we start? Janet, let's give you the first shot at it. What do you keep an eye on?
I never get questions asked to me.
I know you don't. That's why I'm not going to let you off the hook.
Well, I just have to say, this is Bloomberg, so we watch everything. We watch how many people are ordering what at a restaurant, where they're going, how they're traveling among their offices, are they opening new offices, where their customers are. But I guess, as simple as it sounds, it was a question I asked to Megan. We saw that personal savings rate jump because people were nervous and they didn't know what to do with their money. And also they had lost the will to go out and spend money. Now, we saw huge spending over Thanksgiving. We are watching to see what happens over the upcoming, Christmas, Hanukkah, holidays, if people buy a lot more.
Yeah. So consumer behavior is a big issue you look at. Carol, what do you watch? What's your big indicator that you keep an eye on?
Well, our biggest indicator generally is flow of people coming into open houses, but open houses are done so differently now. So showings are a big indicator. The showing of houses, that is just, it's completely unprecedented, the number of people that are looking for homes right now. And then of course, new listings going on the market. So we have the indicator on the supply side and the demand side. So we're hoping for more properties to come on the market. We still have that big fight between those two populations, the baby boomers and the millennials. They're looking for the same property. And our millennials are we're all staying healthier and staying in our homes longer, and the millennials are building their families. So there's going to be a little, hopefully, some loosening with new construction.
All right, and we'll give our economists the last the word here on what to watch for.
So in the short term, I would say I'll be watching the virus data more than anything else, because it's not the governor telling us that we can't go out that means that we don't go out. It's the fact that we feel like going to a bar might land us in the hospital that means we won't go out. And we saw that as the U.S. economy opened up this summer, that actually the spending patterns in the first states to open up and the spending patterns in the last states to open up were identical, because it didn't matter if rules were lifted, people didn't feel confident. So that's what I'd look like at in the short term. In the longer term, after a vaccine is rolled out, I'll look at the unemployment data, because that really is a quick indicator that suggests sort of what direction we're going in, and also what speed. And given that consumption is such a huge piece of our economy, that's going to be driving the recovery.
Great. Megan, Carol, and Janet, thank you for an enlightening conversation. And to our audience, if you liked what you heard today, please continue to stay engaged with the Greater Boston Chamber of Commerce. In fact, next Tuesday on December 15th, our final Women's Network of the Year will feature Ramona Sequeira of Takeda, the largest life sciences employer in Massachusetts. Our 21 calendar is also filling up, so visit bostonchamber.com to see what's in store for 2021 and to register in advance. Once again, thank you to all of our speakers and to you for joining us today. Have a great rest of the day and safe and happy holiday season. Thank you.
Thanks.
Bye.
Thank you. Bye-bye.